Types of support and resistance. Channel lines or channels. We already saw one example of channels in the previous article when we described how to plot a flat trend. Channels definitions. As the name suggests, channels, aka tunnels or sleeves, are parallel trend lines that surround a rising or falling trend at an angle and width that not only captures the overall slope of the trend like a single trend line, but also encompasses most or all of the price range, that is, most of the higher highs and higher lows that define an uptrend, lower highs and lower lows that define a downtrend. Again, the goal is to best describe the overall slope and price range. So don't worry if your parallel lines don't touch all of the highs and lows, or don't encompass the entire trading range. Figure 4.7. This is an example of a rising channel. Figure 4.8. This graph is an example of a flat channel or trading range. This is an example of a descending channel. There are two big advantages of channels over single trend lines. We prefer using channels over simple trend lines whenever the price range of a rising or falling trend can be captured by two parallel lines, because channels provide more useful information. 1. Better guidance for entry/exit points. While single trend lines only tell us about the slope of the trend, the upper and lower trend lines of channels also tell us about the present and possible future trading range. In other words, those upper and lower lines may help us find the best entry and exit points. For taking new long positions, we might try to buy near the lower channel line, which is a kind of support, and sell near the upper channel line, which serves as a kind of resistance. Whether or not we enter at the lower line and exit at the upper line would of course depend on the quantity and quality of the other I-rate criteria we find near these lines. For short positions, we do the opposite and consider entries near the upper line and exits near the lower line. Again, the final decision would depend on the quality and quantity of the other I-rate criteria we see near these lines. Of course, there's a lot more to know about entering and exiting positions than that, and we'll cover many of them later. Here's one detail that's worth covering right now. Beware of using channel lines to trade against the trend. When you use the upper and lower channel lines as entry and exit points, it's tempting to try to play both sides of the trading range by going long near the lower line, then exiting near the upper line and opening a new short position there, with the goal of closing that position when price returns to the lower line. However, trading both the up and down moves can be much harder if you're trading against the trend. That is, trying to short in rising channels or go long in descending channels. As a general rule, don't do it unless you have both of the following conditions. The slope of the trend and channel is very mild and the channel is wide. If the slope is steep or the channel is narrow, you risk hitting resistance and the need to exit too quickly to give price enough time to move in your favor. Figure 4.9 shows an example of how a seemingly well-planned trade closes with a loss because when you trade against the trend of a steep and narrow channel, resistance moves closer with each candle and the trade doesn't have enough time to move in your favor. 2. Second advantage. The other big advantage of channels over single trend lines is that channels offer stronger trend reversal signals when price breaks out of the channel in the opposite direction. In other words, when price breaks out above the upper line of a falling channel or makes a sustained move below the lower line of a rising channel, that's a stronger signal of a trend reversal than a breach of a simple trend line. That's because it takes a stronger change in sentiment about an asset to reverse past an entire trading range that is of course wider than a single trend line. For example, when price breaks down below a rising channel, it needed enough selling pressure to move all the way down from the upper channel line to the lower one, then break below it, and thus cover a greater distance in a move that required more sustained selling pressure. Subjectivity is the big flaw of both simple trend lines and channels. Even though trend lines are useful tools, their construction often requires a degree of subjective judgment. Different traders will draw them a bit differently, and thus won't see support and resistance in the exact same place. That's one reason why we view support and resistance from these trend lines as areas or bands of support and resistance rather than as precise lines. For a more objectively drawn kind of trend line that will look the same for all traders, and thus better tell you what the crowd views as support and resistance, we use a different type of trend line called a moving average.